Ryan, very good to see you. Today, we're going to talk about 3 strategies to reduce your tax burden in retirement. So, again, it's all going to come back to those required minimum distributions. Can you just start at the tippy top, explain what RMDs are and how they're calculated?
Yeah, sure. I mean, managing RMDs, the required minimum distributions, is so important to help minimize your tax burden throughout retirement. But
Yeah.
yeah, RMDs, simply stated, the required minimum distributions. So these are the required minimum amounts that the IRS requires you to take from your pre-tax retirement accounts. So think your traditional IRAs, your pre-tax 401ks, 403bs, all these pre-tax retirement accounts that you funded on a pre-tax basis. Now the IRS says, "Hey, we want to get our tax money." So depending on the year you were born is when you have to start taking those. You'll see for most people nowadays, if you're born 1951 to 59, you'll have to start at age 73. But if you were born in 1960 or later, you can wait until you're age 75. Now, there's some little rules around that. The very first year, you can wait until actually the following year up until April 1st, but you may or may not want to do that because then you're doubling up for the next year. So there's
Mm.
some different rules and nuances around that. But yeah, managing RMDs and figuring out what you're going to do there can certainly help to minimize your overall lifetime tax bill.
And I know you work really hard to make sure your clients take those RMDs when they need to, because if you don't, there's a stiff penalty.
Yeah, it's huge. I mean, it used to be even bigger. It used to be 50%.
It's crazy.
So yeah, exactly. I mean, if you didn't take out the required amount, they would penalize you 50% on the amount that you didn't take out. And they reduced that. They reduced that down to 25%. And then they even have said that if it's corrected in a timely manner, that they'll only penalize you 10%. But here's the thing. We want to avoid those penalties at all costs and just make sure that the required minimum amounts are taken when they need to be taken. And this can get a little bit complicated because some accounts can be aggregated, meaning if you have 2 IRAs, let's say, you could take your RMD just from one IRA and not the other as long as the total amount's taken out.
Mm.
But if, let's say, you're married and you have an IRA and your spouse has an IRA, you can't aggregate those two together.
Mm.
Or if you had an IRA and 401k, those can't be aggregated together. So there's different rules there that are very important to understand to make sure that you're doing this correctly.
Yeah, clearly. All right. So then let's get into those strategies to reduce the tax burden that usually comes with RMDs. The first would be to start taking distributions from those accounts before they're even required.
Yeah, and this kind of goes against, what we've been taught for many, many years because when you're in your working years, it's all about saving and investing for the
Right.
future. Everybody
Right.
tells you, put money away into your 401k, and that's not necessarily bad advice at all. But we have to be cognizant of the idea that eventually that money is going to be taxable, whether we're going to pay taxes on that money during our lifetime or when we pass that money along to our beneficiaries, maybe to our kids or what have you, that money is going to be taxable to them. So we need to think through how we're going to distribute that money, when we're going to start taking that money from from those pre-tax retirement accounts. So even though you can wait until maybe age 73 or 75 to start taking those out, it may make sense for you to start taking money out of those sooner and manage the taxes that you're going to have to pay on those throughout the years. So if you
Mhm.
have money in pre-tax accounts, after-tax accounts, maybe taxable accounts, you're thinking through, okay, how much am I going to withdraw from which account and when in order to help reduce the total tax burden that I'm going to have over the
Mhm.
course of my retirement.
All right. Now, our next strategy would be a Roth conversion. How does this help us with that RMD tax stress?
Yeah, so this is something that may help and may not help. And so it's certainly a case by case basis. But first off, a Roth conversion, if you're not familiar, is simply taking money that is in a pre-tax retirement account and then moving or converting that money over to a Roth IRA. And when you do that, you'll have to pay taxes on the amount of money that you convert in that year. So if you have a $500,000 IRA and you decide to convert the full thing all in the same year, you'll have to pay taxes on the $500,000. More likely, what happens is that you'll consider maybe doing a partial Roth IRA. So then you'll just move over maybe 10,000 or 50,000 or 100,000, whatever the amount is, But again, it's kind of going back to what I was talking about before and thinking through strategically, where am I within the tax brackets? What's this going to cost me from a tax standpoint now? And then what's the break even point, so to speak? Because if I'm going to pay the tax now, when am I going to get some benefit on that at the back end later on in life? When might that potentially make more sense? And
Hmm.
sometimes it makes a ton of sense for you, and sometimes it doesn't, but it does make a ton of sense for your kids. And that's a whole nother thing, because they could inherit money tax free, and they'll have another 10 years before they can withdraw and things like that. So
Right.
a lot of things to consider there.
A lot of pros with those Roth accounts. Absolutely. All right. And then let's get into our third strategy. This is known as a qualified charitable distribution. Can you explain how this works?
Yeah, so a QCD. So if you're charitably inclined, and if you're in a good position in retirement where you've saved up a bunch of money in your pre-tax retirement accounts, but maybe you don't need to withdraw the money in order to provide the income that you want to have in retirement, and you're interested in reducing your tax bill. Well, once you reach the age of 70 and a half, you can move your RMD. You can do up to, in 2025, I think the number this year is 108,000. That's the maximum that you
Wow.
could move over. And so you can do a QCD. You can move the money directly from an IRA over to a qualified charity. And this is very important. This needs to be done correctly. But know that if it is done correctly, that money is not going to be taxable to you, because that
Hmm.
money, you never take receipt of the money. It just goes directly over to that qualified charitable or to the qualified charity. So
Hmm.
that can be great, especially if you get in a situation where you're looking at your RMDs and you go, I have to take out that amount. I don't need that full amount. Then maybe what you do is you have some money, directed as a QCD, and then you take some money yourself. So
Right.
a lot of different ways to approach that.
Right. I always say there's a more tax efficient way too than just putting money in the collection plate. Right.
100%. Yeah.
And again, Ryan, this all comes back to proactive planning. A lot of people assume they're going to be in a lower tax bracket when they retire, but that's not often the case. And RMDs are a big reason why.
Yeah, I mean, sometimes it is the case that people will be in a lower tax bracket. I mean, really, the key thing is how much you have saved, where you have it saved, what types of accounts based on how that's taxed and such. Maybe now you're single versus before you were married, and so now you've got one standard deduction. Your tax brackets change, so there are a lot of parameters there. But absolutely, to your point, managing the RMDs or the distributions from your pre-tax retirement accounts, and really having a game plan as to how you're going to get that money out to maximize that money for you, is very important.
Right. And the sooner you can have that conversation, the sooner you crunch the numbers, the better. So, Ryan, if somebody wants to sit down with you to talk about Roth conversions or other RMD strategies, what's the best way to reach you?
Best way really is to go to the website, which is kravitzfinancial.com. You can go to the contact page there, submit a message. Also, just on the process page there, you can check out some more details and schedule a call.
Great. Ryan, thank you.
Thank you.